Welcome to Idea to IPO. My name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,392 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this point, I'm going to hand it off to our distinguished moderator, Roger Royse. Roger, take it away.
Okay, thanks, Rob. And thank you, attendees, for being here. Thank you, Idea to IPO, for creating this event and asking me to moderate. I'm Roger Royse, your moderator. I am a partner with the law firm of Haynes & Boone, resident in the Silicon Valley office. And I'll be your moderator today for our panel, Venture Capital Funding for Startups in the COVID-19 Era. A couple of quick things before we get going. This is one of a series of Idea to IPO events. You'll see me here about every other Tuesday on either a venture panel or a topic of interest. Our next one coming up is actually going to be a repeat with some new content, a repeat of an old topic, new content. Startups in a down economy, because I think some people would say we're either in a down economy or heading there. So tune in for that. That'll be in a couple of weeks. Look for more information. So for today's presentation, we're going to have a panel for 1 hour, and then at 1 o'clock Pacific, I'm going to open it up to questions. So you'll think of questions as we get into this. Type them in the Q&A box. Down at the bottom of your screen, there's a little chat box. It says Q&A. Type your questions there. Don't type them in the chat box. Type them in the Q&A box. I'll gather them up, and we'll get to them at the end of the panel. Secondly, I want to let you know that this is being recorded. You'll find a recording of this panel on the Idea to IPO YouTube site eventually, and you'll find it on a YouTube site for Royse Law. If you look for Royse Law YouTube, you'll find it there probably by the end of the day, certainly by tomorrow. So if you want to go back and go over something that might have been said, you can find the recording. So finally, before we get going, I would like to know who is in our audience. We're all coming to you from Silicon Valley. I know it looks like I'm sitting in the Idea to IPO offices. I'll let you believe that if you want. But we're all from Silicon Valley here. I know there are people here from around the world from a lot of different areas. And typically, so it looks like we got about half entrepreneurs. We've got a couple of investors. We have a handful of, 15% that identify as techies. We've got some academics this time. That's not that often that we get people from the universities. So we've got a few academics and a handful of service providers like me. This is with about 3/4 of you voting. I'll go for a couple more seconds. All right, so it's 70%, 2/3 entrepreneurs. We'll tell you what, I'll share the results so you can get an idea who's here that are in the audience. So we'll tailor our comments, I think, probably towards the entrepreneur community. You know what, because I'm so inquisitive and I'm nosy, I also want to know where you're from. So let's see, like I say, we're here in Silicon Valley, but we broadcast this all over the world with remote and Zoom meetings, etc. We get attendees from everywhere now, depending on time zone. And it looks like about 1/3, 40% are Silicon Valley, a couple people from other parts of the US. No one yet from China, that doesn't surprise me, given the time zone. Europe, 1/4 of the people are from Europe. We've got 5 people from Canada and Mexico, and 1 person from other parts of Asia. Okay, so it is about half a Silicon Valley audience, primarily a US audience, with a handful of folks, a dozen people from Europe and Canada. All right, so that's it with the polling. Okay, the topic today, venture capital panel, funding for startups in the COVID-19 era. You might remember, those of you who are good followers and viewers, that we did this program in March. We call it How Will COVID-19 Affect Funding for Startups? Now we're going to find out, how has COVID-19 affected funding from startups, from our panel of venture capitalists. We have Ephraim Lindenbaum. He's the managing director of Advanced Ventures. He's also the founder. It's a Silicon Valley-based venture investment fund and venture accelerator. They invest in seed and early stage startups. Nuno Goncalves Pedro, venture partner, Grisham Robotics Venture Capital, managing partner, Strive. Is it Strive or Strive? We'll call it Strive.
Strive.
Okay.
We're not thriving yet, but we are striving for sure.
Ah, there you go.
Yes.
Founder and managing partner. It's a quantitative early stage venture capital fund focused on early stage consumer mobile. And Jasin, managing director of DNA Partners, an early stage venture capital investment firm. They invest in digital media value chain technology companies in the US and China. It says you spend 20 to 30% of your time in China, probably not lately, but historically, right?
Yes, indeed.
So with that, as is my custom, before I jump into Rob's questions and my digressions, I guess I'd like to ask each of you to just kind of give me your summary of how things have changed since the last time we were here, and how funding, not so much how it will affect funding for startups, how has it affected funding from startups at a high level, this big picture, general picture. We'll start with you, Ephraim, since I listed you first.
Yeah, thank you very much. Thank you, Rob, for inviting us as well. Glad to be back with my cohorts here on the panel. So, in terms of how it's affected, I mean, I think it has played out in a way very, very similarly to what we've seen in prior downturns in the broader economy. Venture tends to be the canary in the coal mine. Startups tend to be the canary in the coal mine. When our market tends to get tougher, the broader economy tends to fall a little behind. Now, that being said, there is a tremendous amount of venture capital. There is a lot of cash on the balance sheet, so to speak, of the venture fund. So we are deploying capital. But I think we're being a little more nimble. We have seen significant, sort of pullback in terms of valuations. We've seen a flight to quality amongst our companies, other than certainly COVID-related companies. We've seen some, drops in valuation, a few down rounds. But I think the most interesting thing, at least from our ventures perspective, is new deals are a brand new world for us. So the way we look at deals, is not that dissimilar from what we had. The way that we, sort of meet the entrepreneurs and fund deals have changed. We tend to deploy larger checks than, seed or angel type funds. So, I think for the most part, we are co-investing more so than not with other VCs who have been the initial money into the deals. They tend to know the entrepreneurs. We're relying on our colleagues' representation of the entrepreneur versus the amount of time that we typically would have sat across the table from that person. So, I think that's changed a little bit in our mind. I think deal sourcing is certainly more interesting today, but venture is happening. Venture continues forward.
Okay, thanks, F. Nuno?
Sure. So I think when we had this conversation 6 months ago, if I remember the same crowd, we were probably mostly right. I think we were identifying that there was going to be a realignment of valuations going down, as F was just talking about, that there would be some sparse investment in the space, but I think the degree of selectivity. I think I mentioned back then that it was going to be sort of a cherry on the pie type decision. You can cherry pick literally what investments you want to make and you don't want to make, and be a little bit more selective actually in how you're going to market. There's a lot of noise. There's a lot of companies fundraising, and certainly I think the job of a venture capitalist in some ways has become more difficult because of the noise, but on the other hand, you can be more selective because there's a lot more stuff probably to choose from. The other element I've seen is it seems like the actual amount of capital deployed hasn't decreased dramatically, certainly in certain sub areas like software as a service and a few others. But if you look really closely, actually the number of deals has declined a lot, which means there's more capital per deal being deployed, which means it's probably more mid to late stage that's being deployed right now. So a little bit more conservative as well. If I look at public markets, normally we don't talk about public markets because obviously we are early stage investors and we focus a lot in that space. One of my companies IPO'd through a reverse merger, DraftKings, so very, very happy with that and glad we have a lockup and we didn't feel tempted to sell our stock. And so it's really interesting because in some ways I think there is a little bit of a bubble emerging now in some sub areas of public markets. Software as a service, I think there's a little bit of a bubble right now. You have companies trading at 18x forward revenues, which is like really, even with stupid growth rates, it would be difficult. So there's almost like a passage right now. Everyone's putting their money into tech because tech is going to save us all. And so I think that's one effect that maybe we didn't predict back then. So, I think that's one thing that maybe is different from our last conversation. The second element that we sort of semi-predicted was the ability of venture capital firms to raise funds themselves, which is, obviously much more complex, much more difficult. This is a high-touch sport, so raising significant funds at this stage, unless you have a lot of prior committed LPs, if you're a tier one fund, et cetera, it's a little bit trickier. So I feel maybe there, I would say it's even worse than I thought it would be from my perspective. From my end, things are going well now, but it really took us a while to figure out what was our approach to fundraising our next fund. And, we're still deploying capital from our previous fund at Strive. And also I still deploy capital from Grisham Robotics, but, was in the midst of fundraising for my fund 3 and COVID was just a wall. And now we've passed around the wall. I don't think we went through the wall, but we went around the wall when we found alternatives to it. But that has been much more difficult than I thought it would be, and it's more prolonged. I think the third thing that I would say is, at that stage, I believe I talked about a year and a half to 2 years of we're going to go into this situation of COVID in the US. And in some ways, in my mind, I was thinking, I'm saying 1.5 to 2 years being a realist and maybe too much of a pessimist. And right now it looks like that's probably the best we can get away with, certainly right now in the US. So I'm, I spent a month in Portugal where it felt that we were close to the new normal, although Portugal now has increased as well over the summer. And coming back to the US, I'm like, we're sort of still stuck where we were, right? This doesn't seem like we're moving much further. So this is not really a political comment, but just realizing that one last thought I'd leave is, the different regions of the world are going to manifest themselves in very different ways. And we're starting to see Asia reopening in many cases. And parts of Europe have done some reopening and back and forth. Germany for sure is still probably pretty ahead of the curve. So I think we'll continue seeing that. And that will change a lot of the dynamic around distributed teams, where do you raise money from, et cetera as well, which in our first conversation, we didn't discuss to a large extent.
Okay. Joe, your thoughts?
Yeah, I want to share that, some upfront context of who we are, DNA Partners. I know we broached that a bit, but we're investing in software, in infrastructure of digital media. Our geographies are USA, China, and now we've been sourcing for the last year, the Philippines. And today I just want to think, contextually and the full spectrum from incubation or seed to IPOs. I think we've been in this for about 6 months now, COVID, and I think it is important for us to cover the full spectrum and our interpretations of what that spectrum is from month 1 to month 6 being today. If I had one word to label it, it would be elasticity. It seems like we're just elastic in our philosophies of investing. And the rationales are, I would just put the other word, bizarre. So contextually, that's where I want to come from. we've done 113 IPOs in 2020. 2016, I think we did 105. 2016, we did 105. So we're already above that from 2016. So that's obviously public offering. And then we go to the other spectrum of incubation and seed. We don't have all the numbers collected on that for the USA, but I would say that it's down considerably. That's just my interpretation and my hypothesis. But I would like to say that there's been, July, August, there's been uptake in more and more investments. And I think that the money is getting restless in its accounts, and it's time for the entrepreneurs to reach out to us, to be more proactive. On our last call in March, idea to IPO, I was really aggressive in saying, please reach out, because correspondence is going to be key, because we're not going to face-to-face meetings. So I'd like to say that 1 to 6 months, as far as the entrepreneurs out there, correspondence has been lower for us than in the physical world. And that who did correspond with us, we really feel like there's more confidence and conviction in these executives, which allows us to move faster and with more discipline at an accelerated pace. So in this time, it really it percolates up the transparency of executives and how they approach their companies in general, how they approach us. So I just wanted to share that present tense context.
Yeah, Joe, I think what you're saying is consistent with the facts, the stats that I saw in the money tree about investment. Seems there was a dip, but I've heard that it's back. What have you been seeing? Let's just stick with you for a minute. In terms of valuations, there was a prediction, I forget who made it, 6 months ago, that valuations were going to go way down. Has that happened, or are we in, Nuno, you mentioned a bubble, or are we in a,
Nuno mentioned a bubble for software as a service. It's just been a lot of uptake.
Public companies, yeah.
For public companies. How about early stage? I think we're mostly early stage.
I mean, yeah. So I mean, it really depends. I think it's more of a realignment story. I don't think anybody is in a position to make any, across the board, pronouncements on this. I mean, we are seeing companies on our end that are getting significant up rounds beyond software as a service. Our food and ag companies are doing very, very well. I think we predicted that happen. Our health tech companies are getting valuations that feel like the internet bubble. So I think really what it comes down to are great deals and how important it is and how valuable that company is in this new economy. And, companies that are, gaining traction, gaining market share, generating revenue in this market, I think are being well treated. I think what's happened is patience has thinned, right? I mean, this, 3 years in, we've inched the ball a few yards up the field. That, I think everybody has gotten a lot more realistic. I think, people have their brush with, sort of looking into the abyss, and, we're just, we can't sit around and, kick tires on a lot of these deals. So I do see, VCs, cutting bait, so to speak, in a lot of ways that maybe they hadn't done before. Some of them are taking the hits to the, to the fund, to the portfolio to clear it out. And, one thing that we are seeing is redeployment of capital, right? Release the follow-on offer, requirement on deals that are not performing, and move on. And I think, if anything, VCs have had more time to probably do a deeper dive into their own portfolio and, root out some of the dead wood, I would say. So that's my take, at high level.
I think I was the one that made that prediction back then that valuations were going to come down. And I'd like to say, I think I got the two elements of that really well, which is, I do think the median and average has come down. You see people being a little bit more precise, even raising less money. Instead of it's a Series A, it's a Series Seed 1, or it's a seed and not an A, or it's a pre-seed and not a seed. And so redefining how much money they're raising, with, price caps that are, I think, a little bit nicer. The conditions are moving slowly but surely better and better to our side, to investors and venture capitalists. We're getting better conditions. I feel we're getting to negotiate better conditions as well. I think we had a really long period, as you were mentioning last time, Roger, where we had, you know, entrepreneurs dictating stuff in the Bay Area, and it's being very entrepreneur friendly. I think we're now moving a bit to the other way, maybe not as aggressively as we had anticipated 6 months ago, but certainly moving the other way. I had also predicted back then that the hot companies would always raise. I think the one thing I totally missed is I had not predicted that the companies, the hot companies that would always raise, would raise at stupid valuations now. And it's a little bit the same effect we're seeing on public markets, right? It's like everyone's putting their money into Amazon, Apple, whatever, right? Because it's like, it seems like they're the guys who are doing well, right? So we might as well, right? And it feels the same in some cases in some deals in early stage. I've seen a couple of deals that are like back to the old parity rounds, but it's like seed deals, right? That are raising 5 to 10 million in seed at some absurd valuations where you're like, surely this can't be worth that in the next 5 years or so, right? So I think there's a little bit, I wouldn't call it a bubble, but there's a little bit of an over anticipation. There's limited number of hot assets, either hot teams or hot products or hot areas. And I feel there's maybe a little bit of a lemming mentality of investors, including venture capitalists, deploying too much capital onto them and accepting very wild valuations. But in general, I think we were right 6 months ago. I think valuations have come down on median and average, et cetera, et cetera. It's just the extreme position feels to me like it's gone way off the deep end.
And getting back to valuations where Roger wanted us to just highlight it, I think, Nuno, I agree with you. And halfway through your last comments, I was totally on mark with you. I was thinking 20% of the hot companies, or let's just say 20% of the companies out there, and I'm speaking about USA and China right now, they wanted to go for really high valuations. They were just going for it. Like, we have a lot of momentum. This is what we want. And then 80% of the companies were just like, okay, we're rational. Here we are. We don't know if we're going to be able to get sales. It's the unknown abyss that we're going into. So I would put an 80-20 on that. And, you know, that's quite an extreme. That's not a frothy bubble, so to speak, you know?
You know, F, you said something that I want to follow up on. You were talking about some of the companies that have been doing well, and I really want to make sure we talk about that. What has been doing well in this new economy? I mean, we all know what's, you know, we can guess what's not doing well, but
DraftKings is doing well. Sorry.
Yeah, no, that's great. Congratulations, Nuno. Yeah, so again, I mean, it's really sector based. I mean, I think the number one thing that I would say is our, you know, science project, you know, early stage startups are really, you know, a little harder to get funded today. You know, it really comes down to essentials, you know, and, you know, reasonable companies in health tech that have a COVID bend are doing really, really well. You know, we're seeing tremendous traction in our food and ag companies. They're really have done very well. You know, companies that really can generate core revenue regardless of the economy, essential services, work at home related companies, they're all doing quite well. This shift to remote work, remote health, remote everything is certainly quite helpful there. You know, I think one thing that you know, was probably my most, you know, meaningful statement, I think, is that, you know, when we did this last time, is that I suggested that COVID was going to uncover holes throughout many different elements of the supply chain and industry. And I think that's really been the most eye-opening element to me, is just how much opportunity has been created, how many holes in the various supply chain, how many elements of, you know, sort of opportunity are really developing across the space. You know, does another AI company that maybe does a little bit better BI make a difference? Not to us anymore. I mean, you know, does a maybe, you know, third level AI car company make a difference to us? Nope. But you know what? A logistics company that's using AI to get products and save money and get it in the door, you know, that's great. Could it be AI or gnomes under the hood? We don't care. It's all about what you can deliver today, in our opinion. And, you know, our companies, you know, are doing meaningful up rounds. You know, we are not seeing good companies, to Nuno's point, are getting funded. They are getting funded at a premium today if you're generating revenue, if you're cash flow positive plus. You know, it's the science projects that I think, and the nice to haves versus the must haves that are really having a hard time.
I'd like to compound on that supply chain. So we're in digital media, which has a supply chain. We're just calling it, we invest in digital media value chain technologies, which is distribution. And for us, the uptake has been significant, right? B2C, B2B, B2G, B to government, and the uptake of digital media distribution, whether it's remote work like Zoom or Netflix movies, it's just been extreme. So in that supply chain of tools, or you say tools, you say companies, we've seen a lot of uptake in just the scaling, obviously, of users, and then the scaling of those supply chain companies that need to grow. So it's been great for us as far as DNA partners.
I would go back to something I introduced when we talked 6 months ago, which is the notion of 3 types of markets, right? The markets that are positively, that are correlated to what's happening in the market that is non-correlated. And then within the correlated markets, there's the positive correlated and the negative correlated. I think for the most, the 3 of us got probably almost all the markets right. We were saying, gaming is going to go through the roof. Media entertainment consumption is going to go through the roof. Certainly the digital side, of course, not the physical side. We talked about, travel being affected for a long time. I think we've seen that. There was a couple of companies that are doing okay, but certainly it's a space that's been very, very dramatically affected. I'd say 2 things that maybe we didn't discuss too a lot. I wouldn't say we got it right or wrong, but that we didn't discuss a lot. One, healthcare, and I think maybe F there was probably the most bullish about it. I was probably one of the most skeptical, and I have to say probably F in that sense would have been the one that was right. I think I didn't predict that the withdrawal of regulation would be so significant as we've seen in the US. And so what's happened in the veterinarian services, health service in general, telemedicine, a lot of stuff has been abandoned. So I think we're actually having maybe one of the first real interesting digital revolutions around health. I don't think it's going to solve all the problems, but it's a first little tiny digital revolution that's really exciting. I think the second piece that we didn't discuss quite a lot the first time around is the value of brands. And during a crisis, what happens to the value of brands and loyalty? And the interesting thing is actually people become less loyal, right? Because there is a table stakes play, which is, do you have digital offerings? Can I buy you? Will you deliver? Back to the supply chain point that F was just making. Will you deliver it to me within the next, let's say, week, right? No longer next day, but let's say the next week or next 2 weeks. Or will I wait, 3 months to receive my masks or 3 months to get whatever? And that has shifted dramatically. So in some ways, we now have a market that not only defines digital offerings as table stakes, so it's literally sink or swim. You have no digital offerings as a company, you're just brick and mortar, you are gonna die, right? I mean, either you're gonna die or you're gonna face a really difficult time over the next, let's say, 1.5 or 2 years. Or you have digitally and you can compete. But we have a shift of loyalties on brands, which is incredible. And I think it's just mind-blowing to me what's happening in terms of consumption. And it feels to me a little bit almost like Gen Z, right? We talked about Gen Z in the past and how they have a different set of loyalties around what brands they're looking for. We've just had this amped up because of COVID. People are now focusing on brands that actually have significant and strong digital presence. I only really look at digital advertising, right? Because that's it, right? So if you're not advertising to me, if you don't have a proposition that's easy for me to buy from you, for example, if you're in the e-commerce space, I will not buy, right? And that I think is quite dramatic. And we're starting to see really big shifts around the world. It's not just in the US, of what brands are dominant, right? Coke was the darling, and now Coke, well, good luck to Coke, right? Because Coke's, for example, digital strategy around delivery was not there. I mean, they have a very limited digital strategy.
Wow, that's a lot. It's interesting, the comments on supply chain. McKinsey just came out with a report last week about how COVID has illustrated all the weaknesses in the supply chain. And one of the main points they made was just how interconnected the world is. So something goes wrong in one little space, it just disrupts everything. And sort of on that point, a lot of people are talking about the impact that the last 6 months has had specifically in Silicon Valley, where we all are. And I know there was a time when we did these panels and I'd ask investors, I'd say, gee, will you invest in a company that's outside of Silicon Valley? And they'd say, I won't even drive to Stockton. Why should I? They're all right here. So I'm wondering, has your investment thesis changed any now that everything's digital and less real world? And I mean, have you expanded your geographic scope? And for our entrepreneurs, is there any more need for them to be here?
Yeah, I will take this one first because, you know, on this one I'll take the I'm vindicated play, right? I've been talking about multi-geography investments for a very long time, that there's a lot of innovation, a lot of great startups around the world, that one shouldn't just focus in Silicon Valley. And I think if anything happening right now, that's even more clear because people are distributing teams. You know, the cost of living in the Bay Area has become so absurd that we have, I think, the beginnings of a leaving flood from SF, right? I'll come back with something positive in a second, but you know, right now it's just people leaving. I was year on year, I think July, the number of vacancies for rentals and sales in SF was 96% up, right? Year on year. So if people are saying that it's not happening, well, it is happening. It's factually happening. There is a good positive afterthought. I'll come back to that. But for us, we feel vindicated. I think there's innovation everywhere. I think the US and the Bay Area is still going to be a huge engine of innovation. But certainly there's a little bit more distribution of people right now that's happening because of remote work, because of COVID, et cetera. So definitely that will happen. Presence in the Bay Area and answering that question that you had, I think it still matters. I don't see Silicon Valley becoming irrelevant, right, over the next 2 years just because people are going away. Big corporations are still here. Some of them have very publicly said that they still believe that the presence, the in-person logic is still important. You know, Reed Hastings from Netflix had a couple of controversially interpreted terms, but I think he stood by the notion that people still need to meet. Facebook is sort of edged with a hybrid model. There's a couple of things that now make us believe that even the large corporations that are here are gonna, some of them require that there is some in-person at some point. You know, people do have some of their lives around here. They're not just going to pick up all of their stuff. Maybe they're going to go away for a year and they come back. So I don't feel that, I think the Silicon Valley thing that's happening right now, which is actually dramatic with a lot of people leaving, is a point in time and it will change. Okay. And, you know, Joe probably in FF much better experiences. I wasn't here in the great nuclear winter of 2001, 2003. So they'll probably have amazing stories to share with us. But the tourists left. And back then, from what I understand, the tourists left as well. And so the people that stuck with it are the people that are committed to being here, that are committed to this ecosystem. And I think what we're going to see is a renewal of Silicon Valley. And maybe it's 2 years down the road, maybe it's 3 years down the road, and renewal of San Francisco, which I'm personally very much looking forward to. I think San Francisco is a city with an amazing history that in some ways was a little bit lost in their notion of what does it stand for. And it was a bit of a violent, it was violently aggressed by people that were making way too much money and had no interest in the city except the utility of having great meals and going out and whatever. And I think we're going to have potentially a better San Francisco after this cycle. So it's a rough cycle. It's a rough cycle that's going to take, in my opinion, a few years. But I think Silicon Valley will maintain its importance. And we're going to have a renewal of San Francisco, which I'm very much looking forward to.
Go ahead,
Yeah, I
Joe.
just want to piggyback on that. As far as context again, you know, I've been here since '96. I'm not drinking any Silicon Valley Kool-Aid. If you watch me on stage in China or other countries, you know, I'm speaking about the culture and of Silicon Valley and how it works. But I also discredit Silicon Valley for like its business models and its uptake on apps. You know, apps are going to, you know, serve the world. But to be specific, you know, we did that in 2001, we had a big exodus. 2002, you know, that was a big .com exodus. And then in 2009, you know, that was more of a real estate exodus, you know, more about the macro elements around real estate. But the Bay Area hung in there on its real estate valuations, basically from across the nation, relatively. And then I think if we go to present tense and pandemic crisis, I feel like, yeah, there is a minor exodus, but it's really that millennial generation that came in 10 years ago with the Apple App Store, I'm going to be a billionaire, and code on iOS and Android. Oops, it didn't work. I didn't make $1 billion. I've been hanging out for years after that, just working for any tech company that I can. you know what, I'm just going to go back to where I came from. It's a theme. What I think is, you know, in conclusion of this one notion is, I think it'll create more transparency for human capital to really rise. So the intellect of human capital will really rise, and for the accountability of politicians. So obviously I live in San Francisco County, and I feel like politicians have been waning on accountability for 10 or more years. So they're gonna have to be able to figure out how to draw people to the Bay Area. It can't just be the shiny rock of, oh, Silicon Valley is so great because we're innovators or inventors. It's gonna have to be economics, invention, and intellectuals that are still here, and then accountability for everyone to work together. The beauty of the ecosystem of universities, banks, law firms, large companies, all associations, all trying to work with the startup company. So that better sustain, otherwise we have a trigger point.
I would add one thing to what Joe just said. I'm going to pick up on one thing, just one quick sentence. On talent, I think what he just said is essential, which is the quality of talent in Silicon Valley in some ways. I always used to say that on average, median and top end, probably some of the best people in the world, best talent in the world is here, but the variance is huge. The variance is huge. You still have a lot of crappy talent here. And, you know, I think what he just said is very, very powerful, which is maybe now we'll get a little bit less variance, right? Because the people that will stick around are people that have the right to be here, right? That have immense talent. It's not just, you know, filling in seats on a bus, right? So I think that actually that point he made is actually very, very profound, very, very important.
Yeah,
Yeah,
you've
well-
been so quiet.
Yeah, no, I'm enjoying listening to my colleagues. I mean, look, we've been investing outside of the Valley for a long time. There are companies that need to be here. There are companies that don't need to be here. There's talent in a lot of different places. And I think what we're seeing is, it depends on the stage of the company, what the company's doing and where it needs to be. But the critical infrastructure, whether that's capital, academics, legal, even to a large degree, some of the finance elements, they're all still here. They're going to remain here. To Nuno's point, I think, and this goes back to my statement, nice to have versus must have kind of thing. There's talent in the Valley that is must have. There's talent in the Valley that's nice to have. Nice to have, the companies can shed, they can pull that back in a few years. Must have is must have. There are core engineers out there that, they must be there. I just ran into someone that was being recruited by Apple from Southern California. They're, busting down all the doors and paying all the bills to get this person up into the Valley. And they don't even know when he'll be, needed in the office, right? So I think, if anything, what this is doing is surfacing talent in a broader way. I think companies are determining where the talent needs to land and, what elements of the business need to be in-house versus virtual, et cetera, right? So I think the jury's still out. Let's see how long this lasts. But, if VCs aren't thinking beyond the Valley at this point, I think it's pretty challenging.
Well said.
Yeah. Anything to add, Joe, to that?
No, just well said. I mean, we've been looking at USA, China, and now Philippines. I mean, that's been since 2019, pre-COVID. So you got to get outside the Valley. You can lean on the Valley, but you got to get outside the Valley.
Yeah, so to follow up on that. So I was here in 2001, and this reminds me a lot of 2001 in that the traffic is so much better. I don't know. It's what I think of when I think of those days. The difference is back then we didn't have anything to do, and now we're still very busy.
Well, I'm just the only one going into the office, Roger. We don't actually know the traffic's bad because none of us actually go. You're like an essential worker or something that can go into the office. I can't tell you. Our office is in an 18-story black office building, and there's no chance we're going back into the office for anything other than a masked and gloved mail run. We actually have like a secure mail site off site right now for things to arrive. So it's it can be dependent on that.
Well, on that point, I'd like to ask what you're seeing in deal flow and whether the fact that you won't go to the office has affected your ability to meet new entrepreneurs, talk to new companies, make new investments. I mean, that's on everybody's mind. I hear that a lot. Say, gee, do you think they'll invest in me if we just do this all virtually?
I think Joe mentioned earlier that he was getting less correspondence. If I got that right.
Yep.
For some strange reason, I'm getting more. I don't know if people got my email somehow along the way,
Oh yeah.
I'm
Yeah,
I'm getting a little bit more top of funnel. I
oh
think in
god,
general,
yeah.
getting a little bit more top of funnel. I
We're
think
5x. We're 5x top of funnel.
yeah,
Which is not helpful actually because
it's nice.
about 85% of top of funnel probably should never have entered the funnel.
The cool thing is exactly that, F, which is, people are sharing teasers, they're sharing paragraphs. And right now, because I'm seeing more top of funnel, I'm asking people, can you send me a pitch deck, right? Because it doesn't make sense for me to take a first call unless there's something exciting there. And so it allows you to see a lot more companies without necessarily taking a lot of your time. And I think, our associates, principal, the rest of the partners have been experiencing something similar in terms of deal flow. So there's certainly a lot more. It's more geographically distributed. I mean, to that point, we always were multi-geo since we started Strive Capital. Our first fund, we've had 3 amazing successes. And basically out of those, only one is a US company or a Bay Area company. A second one of them was a company from China that has since did a flip to be a Delaware C Corp, but to be honest, they were originally Chinese. And the third one was a company in Japan. So it's like, we've always believed that, money and returns on investment and great companies are elsewhere. I would say, people are getting really crafty on how they get stuff to us. So like from really smart LinkedIn requests to finding email addresses to, getting warm intros from wherever they can, like semi-warm intros. So I do think that this element of being more distributed, remote working, everyone's sort of getting used to it. And in that sense, we're getting a little bit more productive at processing deals if we can take a look at the pitch deck in advance, et cetera, so we can make calls faster. I personally I've seen more deals throughout, everywhere from top of funnel to due diligence to deal making. I think we've been processing a lot more stuff.
How about you other guys, Joe? You said you're getting less correspondence, huh?
Less correspondence because we've always been like, none of us are on LinkedIn. We don't have a website. We really only correspond via email. We got most of our deal flow from our colleagues. We always want it this way, from our colleagues and from panels when we're,
You need to transform to being digital first. Come on.
I don't need to. Do we want to? No. But I will say that we've had more quality incoming, however we get it, and outside of China and the Philippines, like the UK, we are looking at we'll look at it and we're impressed. And then in Japan, one that we're very impressed with, but it's not like we're going to pull the trigger and go outside of our bubble necessarily just because it's litigious extensively, but we tell them this, we're very transparent about it. But I'm okay with having less correspondence and giving more time to our portfolio companies as well. So that means more email to mobile network operators and big internet companies as far as they're the big buyers of our company's product sets. So it's a nice balance.
Yep, anything to add?
Yeah, well, look, I mean, we're getting a ton of deal flow. I echo Nuno. I mean, people are getting super creative. I respect a really creative entrepreneur. I mean, I've got people like, slingshotting off like multiple second party LinkedIn contacts through someone that I met in high school. To Joe's point, I'm actually not even on Facebook anymore because the deal flow there is scary. LinkedIn, you just kind of, I mean, look, I would say my inbox at LinkedIn is 10x what it was before. I probably only got through 20% of it before, and that means I get through like 2% of it now. We get a ton of deal flow. Like I said earlier, I mean, I think the overarching issue really for us is, to a large degree, we've kind of come to the closure. We're probably not going to spend a lot of in-person breathing in the same room time with an entrepreneur. You know, there is something about that I think we all kind of have this gut feel around. So we do rely way more on our colleagues, right? And I think to Nuno's point is that we had, you know, we're probably less on the earlier stage unless they're proven entrepreneurs that we can really get that collegial sort of, you know, thumbs up from. Service providers like you, Roger, you know, we always looked at stuff from you. We're always looking stuff from you. Some of you guys have lost your filters, I think, but you know, you always are really good at not sending garbage. But yeah, I mean, I think it's really important, you know, when your banker's sending your deal flow, your neighbor's sending your deal flow, you get a little worried. So, you know, I think for us, it's just trying to figure out, you know, where to spend the time. I agree with Nuno. You know, we'll be able to burn through like a, you know, 10, 15 page deck pretty quick. You know, I will say you got to send us a deck. You know, send us a detailed bullet point email there. If we don't get back to you, we're not interested. You know, don't wait for some kind of like, thank you, but you know, you did not get the award from us, you know, and then just kind of move on, which is important.
So I want to remind the audience, the attendees, if you have questions, go ahead and type them in the Q&A box at the bottom of the screen. We're going to get to your questions in about 15 minutes. So go ahead and type them there. I'll gather them all up. Don't use the chat box for questions. So kind of on that point, I guess following up a little bit more, I'm going to talk a little bit more about the future because it's every bit as uncertain, I think, as it was 6 months ago. We're in the middle of a brutal election season, you know, and how that turns out, which is anybody's guess, could certainly impact things. We don't know if this COVID's going to go away or if it's going to come back. There's just a lot of it. We haven't even talked about civil unrest yet. I'm just curious as to how that is impacting your investment decisions, your ability to raise new funds, your desire to hold some dry powder, if at all. I mean, can you talk about that, about the future a little bit? Can anybody want to respond?
The macro stuff thus far hasn't really had any impact on anything I'm doing, fundraising, investing, in that sense, or in the companies. The macro stuff that you mentioned, right? Obviously COVID is, right? Just to be clear, we're separating COVID from the other macro stuff, elections, you know, safety, etc. So the other macro stuff, the elections, the safety piece, social justice, etc., I don't think has really impacted significantly any of my activities. I think if anything, it's given rise to some interesting conversations and discussions at board level with a few of my portfolio companies around what they're doing about it and where do they stand. But again, I wouldn't say there's been a tremendous impact, certainly from my activity.
Anybody else?
Yeah, go for it, Joe.
I guess I have to not guess on our impact of what Washington, D.C. does in respect to, I'll just generalize Asia, and looking at how commerce is portrayed and the accuracy of collecting tariffs and taxes, the accuracy of portraying that to the United States citizens, that those international relations do affect us at DNA Partners. The citizens of the United States and swinging the pendulum so hard, whether it's the press or the citizens out in the streets, I think affects the psyches of every citizen in our nation. And it's really disenchanting and disheartening for me. And so it makes us at DNA Partners filter a little bit more of the psychology of a team that we invest in, because we always say of three categories: we invest in people, product, and marketplace. Marketplace being geography and timing, people, product, and marketplace. And we're investing in the people, number one. So we want to understand, are they a hard pendulum swinger of the cancel culture or not? Or where do they stand with issues in their professional life and maybe a little bit in their personal life? Not that we're digging into the personal life, but you know, who the board of directors are at present tense or their executive team reflects their future thinking. So yes, it affects us in looking at the psyche of the people that we would be investing in.
Interesting, you know,
Wow.
because
I'm just going to take a step back, Joe. You just hang out there in the breeze by yourself, my friend. No, no, no.
Product
We
marketplace.
weigh in on none of these things. No, 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 no. No.
I know I think you've always been investing in product and then people, and I think then
Oh
market.
no! Look, I love the thesis. I'm, anything further than that, I have no idea what you said. I was never here. I don't even know you.
well, I want to drill down a little bit because a little bit different aspect of that, because I heard somebody say at the start of the presentation that, technology is important. Everything is technology. And I wanted to circle back to that, or at least that's what the prediction was 6 months ago. How important is the people element of this, especially now that the valley, the demographics are changing, and are people still number one in terms of when you make an investment decision? I tend to, I see a lot of startups too, and that's kind of the first thing I look at is who's the team, and then whether they've got some industry expertise, and then maybe the technology. Are all those fundamentals still the same? Does that all still hold? And have I got it right, by the way?
Well, I'll be quick. I stated already that people, product, marketplace being geography and timing.
Yeah, it's always people. I think it's always people first. At the end of the day, especially in the earlier stages, even the tech is so entwined with the individuals. Great teams do well in down markets, right? Subpar teams, basic teams do not make it through tough times like this, right? So I think that's a big part of it. Teams that were not sensitive to the political landscape or the emotional landscape of their employees have not done well in this crisis. The people that knew how to listen, and and you could see it. Entrepreneurs that know how to listen, know how to parse the data, know how to be oftentimes just good human beings to start, are carrying the day right now.
I've always been a little bit contrary on this. I love people. You get into deals or not into deals because of people, because of the relationship we have with someone. Some companies are hugely successful just because of the grit and resilience of the founders or the CEO or whoever's involved. So I'm not diminishing the importance of people, and I'm not diminishing the importance of us analyzing them. But we spend a huge amount of time around market. I think to Joe's point, market is a very broad thing. So market is competitive landscape, market growth, adjacencies, timing, and a few other elements that happen in it. We still spend a ton of time with people, understanding if they can fundraise. Can they fundraise the next 1 or 2 rounds or not? Do they have the grit? Do they have any signs of grit and resilience in their background? Do they stick to things? Are they able to withstand pain, right? As Ben Horowitz used to mentioned in his book, right? The hard thing about hard things, right? He talks about this notion of pain, right? So all of that matters a lot. At the end of the day, we're looking for all these elements. So product, tech stack, market, team. We don't second guess markets. I don't have an example of a bad market where an amazing entrepreneur won in. Certainly from a venture investable perspective, maybe some of my colleagues here do. So normally I don't bet in markets that I believe by nature are niche or don't fit well into our thesis. And we spend a lot of time around product market fit. So we spend a lot of time trying to find what I call cheat sheets for product market fit, trying to figure out if there's angles there that really highly de-risk product market fit for us. And that's been one of our claims to fame as a quant fund. So we spend a huge amount of time on that. So again, not to diminish people, it's super essential. It's one of the few parts that I don't think will ever be replaced by a computer. It's sort of the interpretation of people and how we work. So it's part of why we get a job as human beings. But in the end, I think certainly in early stage, there needs to be a little bit, or there should be a little bit more discipline around market analysis and figuring out if there's any de-risking your product market fit or not, which I don't see in a lot of the industry. I'm probably overgeneralizing, but I don't see over a lot of the industry.
I'm not hearing a lot of people talk about the importance of the technology itself. I'm hearing product market fit and team, et cetera. So for the attendees, just keep that in mind. Your VCs are not saying if you have a better mousetrap, the world will beat a path to your door.
It's not that. It's a bit of a. I mean, as you know better than anyone, Roger, it's a bit of a defensive mechanism. It's an edging mechanism, right? If you have really truly unique IP and technology, that has value, right? So you add to your value pool, right? Where you have a team that has value that could be acqui-hired. You potentially will build a product that might have value, and you potentially could build a business that's valuable. Just having tech and IP that's valuable, it just adds to that. It's sort of part of the menu. I now have another item that has value. And so that constitutes an interesting edge for some investors. And I don't think there's anything wrong about it. So having IP and having core tech is nothing wrong about it. It's not the sole thing. And I think maybe around the table, you have people that invest a lot around products rather than on, very hardcore deep tech. Maybe Joe being a little bit the one out on that. But I suspect that's sort of the element here, where IP by itself is probably not super valuable, right? It's just an edge, so it does mitigate some of the downside and risk.
I like the way.
And the great, in fact, I was having a virtual connect with another colleague in the venture space, and he used the term, the valley is littered with the carcasses of the best technology out there. So the best tech very rarely wins. And, it's a combination, to Joe's point and Nuno's point, of market, team, tech, being in the right place at the right time, having the right group of, investors and cohort behind you. So, there are a lot of factors that equal success, as part of that. And I see we're getting a lot of great questions coming in the Q&A side. And, I think we're catching most of that stuff. But these are good points. I mean, I think, you've got to look at relevancy right now. And I think to us, it's not as much, just at a high level looking at the size of market. It's the ability to penetrate it in a meaningful time. I think, we are seeing a lot of the smaller venture funds, even some of the larger ones, really having a hard time, raising additional LP capital. I think there was a lapse in the exit time horizons that, that VCs historically were held to, that is really becoming an issue. Companies that, were from the last 10 years that still haven't exited, that's really hard to raise another round on. Earlier funds that are 5 years in, are not getting any liquidity with their companies and therefore are having a hard time. Now, the good side is we're moving into another mass M&A cycle right now. The big tech companies have a lot of cash on their balance sheet. They have a lot of public market equity to throw around. Apple is, I've heard, that literally they are on almost a buy it one company per day kind of clip, definitely at buy one per week kind of clip. I mean, we are hearing, anything that is, that they can really give a little edge to one of the big players, is other than Amazon, of course, which just is a predator, is getting bought out there. So that is something that's super interesting. The telcos are buying again. So Joe, I'm sure you're busy with that stuff as well.
Yeah.
Are you seeing a lot of exits right now?
We're getting more approaches. That's for sure. We are. So it's great. And I wanted to highlight that. It's like right on, F. You're right on. And that's for USA and China. And I would say China's more aggressive in beating down the startup on valuation and stating like, you better do this or ... And that's a pretty heavy statement. So yeah, M&A is up and it's good for all of us early investors.
Yeah, you're the last guy that's still doing business. Other than vacation, I don't think any of us are going back. At least in my cohort of VCs, I think, we've seen a lot of Chinese LPs attempt to get their money out. They did not behave well at an LP level. They're not going to be welcome back. It is no longer size of cash. I think what is most interesting to us right now is what's happening in the Middle East. That is probably the most interesting thing that we see going on right now. This massive, epic amount of capital just got exposed to the largest startup ecosystem outside of the Valley. And we are just waiting to see that explode. That is very, very interesting. The world's largest sovereign funds that could not find a deal. I remember sitting at, at a dinner in Dubai at one point, and the sovereign fund wealth manager was sitting there saying, gosh, we can't find any deal flow. And I remember thinking to myself that 500 miles west, there's more deals than you guys could ever process. And I think I said that, and I remember he said, well, we can't do that. Well, the gloves are off. And, this is going to be a very interesting dynamic that, Gulf capital can flow directly to Israel versus the Israelis feeling they need to come to the valley to get the big capital. And that is a major shift that is going to impact the valley in terms more so than anything else, in my opinion, that we've spoken about so far today.
Wow. Well, I hate to end on it.
It's a really, really interesting analysis. Yeah.
Before we go to Q&A, I just want to highlight a macro notion of the change about how top down, whether we, government to startup and startup to government. When you're building your startup company, 10 years ago or 20 years ago, Facebook was not thinking about regulatory issues at all. And that's very transparent, and they're still difficult. They have difficulty with creating any type of policy within their company. They love it to be elastic, right? So I just want all the entrepreneurs to make a mental note that, the US has typically been, we'll create invention and innovation down here and it'll percolate up towards the government initiatives or towards regulation. Let's not consider regulation at all or very minimal priority. And then if you go to other countries, like Korea or China or European countries Germany, where it's top down, you go to the regulators first and you consider that, how is that going to work and how is it going to be deployed, and the regulator's going to work with the large corporations and then trickle down to the startups. So when you're a startup, please make a mental note. I think with COVID, you kind of have startups there's finding balance between international companies thinking this way top down and USA companies thinking, I better start thinking about regulators more. So it's starting to have a balance between, we better be considering who, what, where, when, why, and how.
Okay. Well, before we go to questions, I wanted to ask, how does everyone find you folks if they want to follow up with you? I'm going to put my LinkedIn profile on the chat.
Just very simply go to LinkedIn and put in the note that we met through this event. And if you're really, really smart, you will listen to my podcast, which I will put in a second, and say something smart about it.
Smart.
Yeah. Which I do with, by the way, with Bertrand Schmidt, who's the co-founder of App Annie. So we do it together. So it's not just my work.
Cool. I'll look it up.
Yeah, LinkedIn is always the best. Don't feel bad if I didn't get back to you. That means I'm not wasting your time. So how's that?
I chose to take myself off of LinkedIn in 2009. I'm thinking about going back on as a case study because now that Microsoft owns them and there's a new CEO as of June 10th. So maybe I can stand behind them and get more product development. But how to reach me through Rob or Roger is the ideal way. Or if you internet search my name, Joe Jasin, Jasin. I'll definitely reach out to you, but please put in the subject heading when you email me that idea to IPO topic, please. And once again, we're software, infrastructure, digital media, value chain technologies.
Yeah, and I'll echo what Joe said as well. I mean, really going through a trusted provider is the best way to get to us. Look, when Roger sends something to us, when Rob sends something to us, we are expecting them to have filtered that to a degree. They're not sending us garbage, so we'll read it. They're also our friends as much as our colleagues. So, you try not to let down a friend, even if you got to stretch a little. So that is really important to us. If it requires you to sign Roger up, go sign him up. I mean, that's how you're going to get to us.
I just want to note, I have been thinking about this a lot during COVID, is digital business card. And so if anyone's interested in a digital business card type discussion, contact me, because this is so important, where we should be able to just press a button and press a click and click on and be able to share our contact information. So this is ludicrous that we don't have this.
Okay, well, I got to get the questions or Rob's going to yell at me. So first, we got a lot of good questions here. Here's the first one. The person who asked this is gone, but I want to get to it anyway because it raises kind of a good point. It's how can startup tech nonprofits look for funding? So I don't know if there is such a thing as a nonprofit tech startup, but you know, I've been seeing a lot more. Well, okay, I'll let you get to that. I've been seeing a lot more social benefit companies or benefit companies or things like that. Do you guys do any social impact investing?
So I think B Corps and double bottom line companies, et cetera, definitely are getting capital. So, and there's more and more impact funds coming out. And definitely even some institutional venture firms that are looking more and more into that space. If I saw the question correctly, this was more of a classic nonprofit, so not a B Corp. And so answering that question specifically, I think that's a little bit trickier because obviously we are for-profit organizations. We have investors that give us money in many different fashions, but classically into a fund structure. And so from that fund structure, we take ourselves something called management fees to pay for salaries, offices, et cetera. And we get hopefully part of the upside, which is what we call carried interest. And so it doesn't make a lot of sense for us to invest in things that don't get any return to us, right? For obvious reasons, because the whole business is based on people getting money to us so that they get amazing returns and we also get part of that upside. So there I would focus. I've been on the board of a couple of nonprofits. Actually, before this call, I was almost late for this call. I was in the midst of a discussion with a nonprofit that I'm super excited about. And I mean, there the sources are different. It's, you know, foundations, government grants, high net worth individuals as well, family offices, which are similar to us as funds. But people that are really more focused on what impact would you have that is not necessarily financial return to them as individuals or as a fund or as a financial investor, right? So very different animal. I personally don't invest in that space. As an investor, I do obviously donate money and donate my time to nonprofits. One last note, I would say there's actually some of my best ever investments, certainly that started as an angel. I have been companies that have both focused on generating amazing returns and are changing the world. So it's not impossible to invest in companies that have significant impact from a society perspective, from an environment perspective, from a health perspective, et cetera, that also are great returns on investment. So that's the only thing I would say.
Yeah, I mean, I'm going to echo that. I mean, having been, you know, plant-based protein investors, you know, really, you know, focusing in areas where we can kind of blend what I like jokingly call altruism with our greed is super important. But to Nino's point is that at the end of the day, you know, we have a day job, and that's to return capital to our investors. As it applies to this, I mean, from a nonprofit, this is a great time as a nonprofit. I mean, you know, sadly, what has happened is there's been this great disparity of wealth in this country. So there's significant wealth at the top of the food chain. You know, bankers, impact funds, family offices are all looking for interesting nonprofits. If you could show greater efficiency through technology, greater return on their investment, because although they don't look for a cash investment, they're looking for some other, you know, metric to follow. I think there's a lot of opportunity out there. The last part of that question, supporting funding opportunities for female entrepreneurs, there are a ton. This is the greatest time in the history of venture to have the support system that female entrepreneurs do. You know, and there are tons of organizations out there in the Valley, tons on the national level, Astria, She CEO, et cetera, that are incredibly supportive of that. And please, you know, get on the internet, spend the time, and you will find those folks.
I think this has been a good question for me to think about it in real time, iterate in my head in real time while the two other panelists were answering. I was thinking, oh, Tom's shoe business model is pretty great. I mean, I'm talking about philanthropy in that way. And then DNA Partners, we are, you know, in the intangible goods world. So maybe someone creates a song and they get commerce for getting the song or the video or the TV show. And then they give one song away. I think that's interesting. So we're always looking for new business models at DNA Partners in digital media. So I think it's pretty interesting idea if there can be a hybrid.
Okay. Next question. What factors are you looking for in a company or idea in the near future, or say 1 year before you invest in it? I know we kind of covered that in the last year, but anything you want to focus on or dial in on?
Well, I've been a diehard of AR, VR, and I really feel like, and had nothing to do with all the rumors or whatever Apple's doing. I don't care what Apple does. I never did. Everyone on the panel knows that about me. But I just think that since Consumer Electronics Show 2020, it's just, we've come a long way in that 9 months, that the international landscape for AR, VR, and we're talking about, let's just talk about glasses versus goggles. The iterations have come a long way since then. So I think it's pretty exciting.
Interesting.
Is this sorry, this is the question around the factors we're looking for? Is that
Yeah, what factors are you looking for in a company or RID in the near future before you invest?
We don't invest. We very rarely invest that early. I would say I wouldn't say we never invest, but very, very rarely we invest at an idea stage.
Mhm.
So from our perspective, you need to show something, at least an MVP, something that's working. And ideally, if it's in consumer, some beta test information, closed beta, maybe public beta would be better. So we're looking for some type of product development, technology development, team formation, and actual traction, early numbers that we could take a look at, even if it's just, again, a beta. The bar, I think, has gone higher because, again, the cost, in particular in software, I think in physical tech, things are slightly different. But in software, the costs of developing some of these platforms have gone down so dramatically that, we would expect you to have raised a little bit of money from friends and family or angel investors or whoever's coming before us as institutional investors. So there's a little bit of that lag that you'd need to fit. So just idea, very, very uncommon that we would invest in. I can't recall the last time we did.
Okay.
Yeah, so and I'll echo all of that, and we're even further downstream from Nuno in regard to that. I mean, the number one thing that we're going to look for is customer feedback, whether it's paid or beta. You can tell me all day long how important your product or service or software is to the world, and unless you bring me 3 customers that are willing to write a check, even if in its nascent form for it, we're going to be hard pressed to really buy into that, regardless of the market size, regardless about what we think. To us, this is all about, can you get sales traction is this a must have in this current economy?
Okay, we got a question about India, especially given what's going on in the supply chain. Would any of you guys ever invest in India?
Yes, but from my end, I've invested in China, Chinese companies, Japanese, Southeast Asian, etc. India, yes, but I think it's one of those markets where I absolutely would want to go with a strong co-investor that can really help with the due diligence on the ground. And again, I'm not trying to make this comment as a sort of a biased comment. It's just my experience in doing business in Asia Pacific over the years has shown me that there's a lot of intricacies to the business in India that if you don't have feet on the ground, if you don't understand, it's even difficult, for example, to do some background checks on people, etc. So I felt that over the years, and just to be clear, my bar on China has gone to the same level. If there's no feet on the ground to help me, I would probably not do the investment. So very similar for India, but I would definitely invest in India.
And for us, or even me, it is of curiosity. And I was at the GSMA Mobile World Congress Shanghai in June 2019. And I met some very interesting Indian companies there. And then obviously we see Google and Facebook making billions of dollars investments in 2020. I just like to throw a caveat out there. If we were to look at it, it would probably have to be on the foundation of Kai OS, the feature phone / mini smartphone operating system that is the second largest OS in India. So it goes Android, Kai OS, and iOS third.
Okay, I don't know if anybody here invests in semiconductors or systems, but the question is, proof of concept is expensive. I mean, more generally, I mean, you see that in other industries as well. How do you solve that dilemma when it takes a lot of money just to prove the concept?
I've looked actively at it in the big gold rush of bit mining. I went back to looking at it. I have not invested in it in a long time, but I've looked quite heavily at it. I think it is also true of, as we were talking about before, physical tech companies and hard tech companies, that, you know, the first stages of development are more costly. They need to be done also in a different process. It's more waterfall rather than agile. So in some ways, there's obviously a cost relating to that, to get something done, prototypes, first releases, to early customers, etc. So I would position that as there's a slight delay in everything we're saying. So in some ways, what I was saying before, the bar for investing in software is here for me, and I'm normally, I'd say, pre-seed to seed investor, depending on where we're talking about. You know, the bar is one step further. So a company that's at Series A probably will have launched, but won't have a huge amount of traction yet. Whereas a company in the software business at Series A will have to have some clear signs of product market fit. Right, so there's a little bit of a delay between stages of investing, and that's the expectations we would have. I would still expect you as a founder to be super efficient about the capital you're given. So it's not like, okay, I'm going to do a semicon company. My first round needs to be $5 million. Unless you're a superstar and you've done it before, super successful entrepreneur, et cetera, it's very unlikely that you get to raise $5 million up front. So you'll need to start more or less with the same money that any other industry would need to start with. And your milestones are obviously one step behind, right? So you're not getting to the same level as a mobile app developer would get in terms of development of their product, MVP, et cetera. So that's how I would look at it. It's still, you know, hundreds of thousands of dollars that you'd raise in your first stage. You need to figure out what would be the milestones for that and have a clear anchoring that allows you to go to the next stage and then raise some more money, either from other angels, micro VC funds, et cetera, et cetera.
Yeah, I mean, I would really, even take a step back from that and say, look, there are incubators now globally that are focused in the semi space. They know a lot of that. There's a lot of pooled resources there. They can help you get to those critical MVP points that Nuno's talking about. There is a bit of a renewed interest in semiconductors, but it's a very thin. It's a very thin category, and you need to have a lot of, proven winners on your team, advisors, board members that can help, I think validate that this is a big spend that's going to be successful.
I'm excited that that question came in. I think it's great. Let's keep it going. Let's keep up the invention in semiconductors. I think a specific vertical of interest, just the huge generalization, is movie studio quality camera, where you're working with chipsets with those types of consumer electronic manufacturers, the high end, very, very high end subsector. And then for DNA partners, this is just a one-off. I think that we would be interested in investing in an eSIM solution set. Obviously, that's not a semiconductor, but anyone out there, eSIM.
Okay, I like this question. Somebody who wants to know if he should have a co-founder. How important is that? And in particular, how important is it to have a technical co-founder?
Well, we almost always need to see a co-founder or at least some element of management team. I think it speaks to a lot of issues. One, does that person work with others well? We are always suspect of the single co-founder. Number two, what if that person gets hit by a bus tomorrow? What happens to our money? So, there has to be, succession plans. There has to be a broader factor. we like to see, 3 minds are better than one, right? Founders that say, look, I can do it ourselves, probably have bigger issues. And so we always like to see it. I mean, and we really don't work at idea stage where we're going to roll up our sleeves and help people, get them those. So please don't send us email. Can you help me find a co-founder? Because that's just not what we do.
That's your role, right? So I won't, what F said is spot on, right? All the risks. So single co-founder, you need to understand, single founder is obviously riskier than 2 or 3 co-founders around the table. For the reasons that F just named. Would I still invest in a single co-founder? Potentially, yes. How would I de-risk it? I would de-risk it exactly with what F said at the beginning of his statement, which is you complement it with your management team. So maybe the people around you are not the co-founders formally, but they are around you. Now, if it's a really small team and the people around you they're pretty early and they're probably not getting paid much and they have great upside, and you consider them truly your right arms and your left arms, etc. Maybe they should be co-founders, even if it's post hoc. They were not there at the moment of founding, and we've seen that in the past. So that's another thing. It's not a hack. I mean, a co-founder dynamic. It's a pretty important dynamic. We've seen if we start having like 3 co-founders or more, the likelihood at the end that one of them or more drops out is pretty high. From the company. So again, if you have like 5 co-founders, that's weird. Like why? Not impossible. So anything that looks a bit odd to us is sort of a manifestation of risk. You need to complement it with your management team. You need to show us, okay, I don't have another co-founder just because of how this happened and panned out, but here's the rest of my team, right? And they're fully committed and they're highly capable to get us to the next 2 or 3 years of growth.
I think what the 2 guys said before this is great, and I don't disagree with anything, but I want to be a contrarian. I mean, co-founders did not work out well for Zuckerberg. I mean, this just drives his own entity pretty much from the outside looking in that perspective.
But to Nuno's point, they hired in some very high level people that are still surrounding Zuck early on. I mean, Boz was there from the beginning. I mean, no offense, man. I mean, as we all know, Elon Musk, Zuck, not a lot of co-founders floating around. But at the end of the day, to Nuno's point, a lot of the people that are around him, to a large degree are kind of considered co-founders. There was also a fairly large legal problem there. So not a lot of folks wanted to wear that T-shirt because you got sued when you wore it at Facebook. So I'm not sure I buy that story.
Well, you're not accurate in your reply. So I said founders, and you're saying advisors could be founders.
No. Employees.
Boz
is an employee.
I think that founders hasn't worked out very well for him. I know we're talking over each other here. And F and I always come out at the end of the day being nice colleagues and friendly. But that I don't agree with advisors or founders. I think he's had some excellent advisory, and I say that
I didn't say advisors, Joe. I said employees. So Bosworth is an employee. He's one of the early employees.
Okay.
Yeah.
And so I don't know. Like I said, I agreed with you guys before we started this talking over each other, but I just wanted to be a contrarian and say that my perception of outside looking in, it doesn't look that great for founders with Facebook, but I also want to bring up another idea, notion, possibility during this time of remote employees is that I think one reason why that we're looking at the Philippines is that we could have a CIO, CTO from the very beginning of a small company be a team in the Philippines. And we'd have an advisor or a board director or a VP level consultant manage the strategy, the architecture, and have it really be deployed and built in a different country. So I think that's something to really consider in this time, in this daytime. And then I think just the general question that the person asked, should I have a co-founder, should I not? I think that depends on your experience. I think that depends on how you have chemistry with other people. Ask your, Myers-Briggs psychological question if you should have a co-founder, not us.
It's very funny because I was mentioning these three companies that did incredibly well for us in our fund one. And, I was just going through it, and all of them, there were two co-founders, all the three, which doesn't necessarily mean it's a pattern, just to be clear. I mean, I still understand a little bit of statistics to understand it's not a pattern. But it's very funny because all three of them have different qualifications for the co-founders. So one of the co-founders was the company spun off from somewhere else. And so one of the co-founders was the person from the original company who then was on the board, but he was actually not deeply involved in the day-to-day. The other one of the co-founders left after a while, and then came back and actually took a role in the company, which is funny. And the third one, there were two co-founders, and they're still two co-founders, and they're still there, and they've been there for a bunch of time, and I don't know if they'll ever do anything by themselves, right? So again, there's different ways that having co-founders around you can manifest itself, and it's not always classically like CEO and something else, CEO, CTO, CEO, COO. It could be in different ways.
Okay, so somebody asked the panelists to comment on investor interest in fintech for consumer. I guess we hadn't talked about that. And then secondly, B2B software for it's a collaboration and networking tool, it looks like to me. Anybody want to talk about that?
I'll take the fintech one, and it's consumer. We're super excited about fintech in general, but let me be clear, we're talking about fintech. We're not talking about what I call, the equivalent of DTC, direct to consumer 1.0, which is optimizing marketing, SEO, etc. And then we get some money out of the interchange rates because something, right? So we're talking about real tech, right? So we're excited about tech. We're excited about financial tech. We're excited about companies that want to serve consumers better with fundamental shifts, at least at product level, ideally with some tech behind it, right? So it's not just, again, interchange arbitrage, marketing optimization, SEO stuff. That's old school. It doesn't get you to the next level. You don't win, right? I mean, with all due respect, you don't win. The big financial institutions still have a lot of power in the market. We're interested in stuff that is fundamentally shifting how products are used, at the very least, ideally with some changes and some significant tech platform changes behind it.
Anything else? Okay, question is, will big tech companies with all their cash co-opt VC's investment opportunities in technology? How about that? Are you seeing strategics come into the market or corporate venture capital playing a more prominent role?
Yeah, I mean, until the COVID, crisis hit, CVC was at an all-time peak. We were seeing a lot of CVC. There's so many different flavors today. There's on the balance sheet, off the balance sheet, arm's length, et cetera. So, it's such a broad category. I will say post-COVID, unless it was an off-balance sheet story, they pulled in all the tentacles. And at the end of the day, the balance sheet investing has turned more of an M&A versus an investment story from our perspective. The off-balance sheet guys, they're just VCs with a hunting list from their parent, right? So, they're really out there on their own to a large degree. But yeah, I mean, that's a pathway to acquisition. All the same perils lived there, before. I would say, though, the value of cozying up to a big partner today in the COVID crisis has a lot more value than it did before the COVID crisis.
Okay, this is an interesting question. How are VCs in other countries dealing with this? Are they different than Silicon Valley VCs? And are you seeing them more in your backyard these days than you did before because of what's going on in the world?
So that's really interesting. I mean, we do a lot of work with, our later stage companies have a lot of capital from overseas. At least from our experience right now, European VCs are really challenged. I think that, Europe has been a challenge just in terms of market size for a long time. I think the shutdown has further echoed that to a lot of them. I'm getting a lot more outreach from, European colleagues, people I haven't done a deal with in 10 years, reaching out, trying to get into US deals. With the closure, I think a lot of this has become very insular, right? Money is not going into China, coming out of China. A lot of areas like Southeast Asia has been abandoned by a lot of the European investors. It's all gone to the Chinese right now. We're seeing a lot, Chinese are very active in Africa right now. In fact, that's sort of the battleground of US, impact funds versus Chinese, government funds. So it's very interesting. I think what has happened in this is made a lot of folks worry about the size of their universe. And, you know, with the shutdown, size of market makes a big difference, because if you're trying to, peel off little pieces of the market, it's very difficult in other countries.
Okay, well, we are at 1:30. It's too bad. We've got a lot of questions here. I'd like to know the answers to a lot of these questions myself as I look at them. But unfortunately, we need to be respectful of our panelists' time. We're not going to get to them. If you have contact information, please follow up or just email Rob. He'll answer all those questions for you. Speaking of Rob, I want to bring Rob back. I want to thank our panelists, and I want to thank you attendees. Rob, back to you.
That was an awesome panel discussion, somewhat entertaining. Thank you, Joe. Thank you, Nuno. Thank you, F, for being with us and sharing your expertise, insights, and your crystal ball. Roger, thanks for moderating. Audience members, thanks for tuning in. Thanks for asking great questions. See you next time.
Thanks
Thank
so
you,
much,
guys.
everybody.